Welcome to another episode of Aliyah Money Talks, brought to you by Blue and White Finance. As we continue our series talking about tax and Aliyah tax topics, I'm thrilled to have Ely Cole on the show to discuss something that I think we all are interested, all of us Americans that made Aliyah, which is understanding the U.S.-Israel tax treaty and how it affects us. So, Ely, why don't you jump in and tell us a bit about yourself and your work, and then we'll get into the crux of the issue.
Sure. Hi, my name is Ely Cole. Thanks for having me. I am a partner at Cole Waxman Tax Services. We're a U.S. accounting firm based in Israel, specializing in U.S. tax reports for Olim or anyone living in Israel that has to file U.S. tax reports for whatever reasons. We also have clients in America and all over the world, but really our specialty is working with people that have something to do with Israel for a variety of reasons, one of which is our specific knowledge of the U.S.-Israel tax treaty, as I imagine we'll get into, but each country has its own treaty. And, the average accountant living and working in the U.S. That's familiar with your W-2 income and your 1099 and K-1s, they're, first of all, not going to be familiar with foreign income in general and foreign banks and pensions. And they're also probably not going to be familiar with the tax treaty between U.S. and Israel.
Yeah, no, it makes total sense. So why don't we jump into that? What is the U.S.-Israel tax treaty? When did it come into effect? And generally, what does it matter to those of us who made Aliyah?
Sure. So it's important to understand when it comes to taxes. Everyone knows the IRS, or the IRC was the IRS, the code that makes up the rules and regulations of the IRS, and that's when you look at preparing a tax return, you look at publications, see what should be taxed, what the rules are. That's one branch. Then we separately have what's called a tax treaty, and the treaty actually supersedes the IRS codes in most ways. And so that the way it works is every country many countries have a treaty with the United States. Really to address, people often say, yeah, I'm making Aliyah. Great. So no such thing as double taxation. I don't have to worry about paying any tax. And I'm sure, I tell people regularly, I'm sure you guys, there's many, listeners here have probably seen this many times, that's not always true. There's a concept of no double taxation, but there's many exceptions to it that we get into. But there's various tools to try to minimize double taxation, or at the very least to try to make the system fair however possible. And one of the tools of making things fair is the U.S.-Israel tax treaty. The treaty is designed it addresses American citizens that because they're a U.S. citizen, they're still obligated to pay U.S. tax as they're a U.S. citizen, but they're an Israeli resident. So even though you're a U.S. citizen, you're not a U.S. resident, you're a resident of another country. So yes, the IRS has certain rules that they talk about to help you out, but there's also this tax treaty between the two countries where they will let you, they'll determine which of your income should be taxed by which country first, and give you certain protections to, where possible, avoid or minimize excess taxation from the complexity of having residency in a different country while you still have the citizenship in the U.S.
Yeah, makes sense. So how long ago did this come into effect, this actual treaty? Is this a relatively modern document or not so much?
I think maybe it was 1975, sometime in the 60s or 70s when the treaty came about. Don't quote me on that. You could look it up. But 60s or 70s, I think 60s is when it started. But I think the more interesting part is the last time there's been what's called a protocol, a change to the treaty, was nearly 30 years ago, which is kind of crazy because you think of how much has changed in just the world and tax law and things like that. There has not been an update to the treaty itself since 1995.
Yeah, I mean, so much has changed. So I imagine that requires a lot of interpretation in applying everything that's 30 years old to very new, investment systems and retirement systems and all kinds of things that have changed. If we get into some of the details here, when we talk about U.S.-Israel tax treaty, a lot of people want to know who gets first dibs, right? And we talk about different types of income. Who gets first dibs? Let's talk about U.S. sourced investment income. Very common thing. Somebody has a brokerage account. They've got their ETFs or mutual funds or all kinds of things that they're making Aliyah with. Who gets first dibs on investment income, on dividends, on interest, on capital gains? Do you have a brief summary of how that works?
Sure. So according to the treaty, let's start with if you have dividends, you have a U.S. brokerage account earning dividends, then U.S. gets first dibs. And it's important to know that first dibs in many cases doesn't really matter to the bottom line. You're paying the same amount of tax anyways. In most cases, you're just saying kind of who might be cutting the check to first. So let's just say you have $10,000 of dividend income from a U.S. brokerage account, and your U.S. effective tax rate is 15%. So you have $10,000 of dividend income, you'll pay the IRS $1,500. You'll then report it to Israel, assuming you're past the 10 years and subject to the Israeli tax on it. And the Israel tax rate, presumably in most cases, 25% on these dividends. So Israel's 25%. You get the credit for the 15% you already paid to the U.S., and the extra 10% would be paid to Israel on dividend income, as opposed to capital gain income from sales of securities, where Israel gets first rights of taxing it. And so you'd pay the full 25% to Israel. So if you have $10,000 of capital gains, you'd pay Israel $2,500. And on the U.S. side, you'd say, U.S., I usually would be owing you 15%, but I already paid that to Israel and more. So I get the credit to not have to pay the U.S. anything. So with dividends with capital gains, same bottom line, which is you're paying up to the maximum rate between the two, income tax, which is 25% probably. And then the other country is just a matter of kind of who you give first to. Interest is, a lot of these things are not as black and white, because the treaty in general, I always tell people, treaties written by lawyers, not accountants. There's interpretations and things that are not so black and white. So interest is definitely a little bit of a gray area. My firm's position is, in my opinion, is that interest gets taxed first by the U.S., same as dividends. There are some of my colleagues who I respect, and I don't strongly disagree with their approach, will treat interest like capital gains and let Israel tax interest first. It's something that, again, we just make sure to coordinate with the Israeli accountant, make sure that, most important is that whichever country taxes it first, the other country is going to recognize that credit to avoid being taxed twice on the same.
But at the end of the day, you're paying the highest rate, and that's what everybody's got to know is you're not paying double, but you're paying the highest rate. Great. So one more example, I guess, on that I'd like to unpack a little bit is real estate. If somebody makes Aliyah, or they're planning on making Aliyah, they purchase a investment property here in Israel. They rent out that property, and now there's some rent coming in, rental income, or they hold on to that property. Now they're ready to make Aliyah. They sell that property in order to buy a new property, and they've got a significant capital gain. We know how the real estate market is in Israel, so they're sitting on a big capital gain. How might that be treated by the tax treaty?
Well, so first, as far as rights of taxation, if it's Israeli real estate, Israel would have first rights of taxing it. If it's U.S. real estate, whether it's rental income or capital gains, the U.S. would have rights of taxing it. And I usually listen to Americans, they get this pretty quickly. It's similar concept to how it works with state income tax, where if you are a New York resident, you live in New York, but you own a property in Indiana, and that property has rental income or capital gain income, you first pay tax to Indiana, because the income, it's a property in Indiana. It's sourced in Indiana. Yeah. So that's where the income's derived, and that's who taxes it first. And then as a New York resident, you'll file your New York return, take a credit for what you already paid to Indiana. And then there'll obviously be excess, because New York is going to be higher than Indiana. And you'll pay the excess there.
That makes sense. Okay, so moving on to another, I think, common question that we see, another topic that I think many people making Aliyah think about is, let's say I'm making Aliyah close to retirement and I'm getting ready to claim Social Security. I'm going to start receiving Social Security income. Whether I receive that Social Security income into my U.S. bank account or I get it directly into my Israeli bank account once I make Aliyah, how is that taxed?
Sure. So Social Security benefits are going to be exempt from taxation, actually, for both countries. That's because of two components to it. First, Israel just says they don't tax U.S. Social Security benefits. So Israel's not taxing you on it. That's not a 10-year window. That's a forever window. So as an Oleh Chadash, the first 10 years, you're exempt from all your U.S. income. Even after the 10 years, Social Security is not taxed by Israel. On the U.S. side, U.S.-Israel tax treaty has a clause where they say that that when you are a Israeli resident, a U.S. citizen that's an Israeli resident, does not have to pay the U.S. tax on their U.S. Social Security benefits. So we will take a tax treaty position, and this is again an example where sometimes people will make Aliyah with retirement income, and they'll say, well, I'll just keep my local U.S. accountant because it's just pension income and Social Security and some investments. As far as they're concerned, what's the difference moving to Florida versus moving to Israel? They're just going to report what I have. But it's important that, again, that many and now some U.S. based accountants are somewhat familiar with it or will do their research, but I've seen many cases where people keep their U.S. accountant and they go on filing a U.S. tax return, but not backing out the Social Security income. They'll keep paying tax on their Social Security benefits because they're not aware that you can take a treaty position, and that's tax form 8833, which you include the form 8833. You detail the section of the tax treaty that Social Security income relates to, and then you can exempt the Social Security income from being on your tax return.
Okay, so continuing on the retirement income discussion, when we look at someone who's retiring, they often have very large balances in retirement accounts. If they're making Aliyah from the U.S., it could be money in 401ks and IRAs and potentially pensions, depending on how long ago they retired. And somebody in Israel who spent a lot of time working in Israel, they could have an Israeli pension built up. How do the different countries, how does the U.S. tax, this kind of income? Who gets first dibs on money I'm pulling out of an IRA?
Sure. So for most IRAs that you have, most working pensions, U.S. will give Israel first rights of taxation. So Israel will be the first to tax your working IRA. Inherited IRA would be different. It's called inherited IRA is out of scope for this conversation. You can maybe decide to bring it up later, but they're complicated. Yeah. So standard IRAs, U.S. says Israel gets to tax it first. So that's according to the tax treaty. Then as far as how taxation goes, so Israel chooses, the way Israel taxes these, the IRAs, the pensions, are essentially, for the first 10 years, Israel says, we're not taxing you at all because it's exempt for 10 years. And then you're just paying your regular rate to the U.S. as you would anyways. Because the U.S., there's the special benefit for Social Security benefits where they let you exempt it. For a standard 401k, IRA, pension income, it's taxable income. So they say Israel gets first rights of taxing you, but we're going to tax you after that at whatever rate we would be, less what you pay to Israel. For the first 10 years, you're paying Israel nothing. So you'll pay us whatever your rate says to pay us. After 10 years, Israel's going to start to tax you on the pension. Essentially, Israel says, what would be the U.S. tax rate on this pension? That's what we're going to tax you at. So that you're not paying any, and there's different Israeli accountants have different approaches how to make this exact calculation. Do you include the other income? Do you back it out? Do you take the deduction? But it's never going to be a higher tax to Israel than what it would be in the U.S. So it ends up just being, let's say you have $100,000 IRA distribution every year, and your U.S. tax rate is going to be 20% on that. The Israel tax rate maybe be 20%. It might be 15%, might be a little lower based off of the complex calculations. If it's lower, You just pay the difference to the US, but the bottom line is going to be your actual tax to pay is going to be the same or lower to Israel, and then you'll pay the difference to the US. So it's essentially the same tax. So when it comes to the IRAs, because it's actually very relevant with the IRAs and the Social Security benefits, is that there is also, and again, there's different paragraphs of the treaty that refer to different things. But there is a part of the treaty, and this has to do with the new protocols as well, where you are able to treat certain types of annuities similar to Social Security, not like just an IRA. So, like we said, standard regular 401ks, IRAs, your regular US pensions are going to be taxable to the US. Even after you're living in Israel, again, Israel might tax you first, but you're still paying tax, as opposed to Social Security, which the treaty lets you exempt. Well, the treaty will also let you exempt certain types of annuities. In particular, a lot of times you see this with like government pensions. So, some like my father worked for 40 years for the state of Ohio as for Attorney General's office. He actually doesn't get Social Security. He gets an annuity from the state of Ohio. So that annuity is essentially treated the same as Social Security benefits. It's the same. It's a similar-ish. It's its own clause, but it's able to do the same thing. Where even though you would probably think of it as a pension, but because it's structured with the annuity and it fits the definitions of it, we can actually exempt it if you make Aliyah. It's one of the reasons I'm pushing him to make Aliyah. But if they would, move here, he could actually exempt and actually reduce his tax because that pension falls under the annuity definition. So we see this with government workers or some people like, certain union workers, where sometimes their pension actually meets this annuity definition that we can actually exempt it. And then sometimes you have to bring in an attorney to make that determination whether something can qualify or not. I've seen some people that try with saying, "Oh, it's my IRA, but I'm going to take it out." As an RMD?
Yeah. Are we specifically talking about government-backed annuities, or is it potential? Somebody's buying a immediate annuities or some sort of insurance product that is essentially an annuity. Could that also be one of the considerations here?
I'm not comfortable saying no, but you'd have to structure it a certain way with someone that sets it up properly for you. I haven't yet really seen that work, but there's definitely potential for something out there.
Interesting. Very cool. So jumping back, I wanted to just start to understand some of the double taxation issues that could potentially arise. Can you explain to me what's the difference between an income tax treaty and a totalization agreement? I've seen these terms thrown out there. And what does Israel have? Israel and the U.S. have, and what don't they have?
Sure. So the income tax treaty we kind of talked about, and I talked a little more about. That's the agreements between the two countries that kind of supersedes the income tax rules and is in place for that. A totalization agreement is a separate type of agreement between two countries. The main purpose, I believe, is actually to address, it probably does other things too, but the main purpose for our discussions is when it comes to Social Security taxes in different countries. So let's say a U.S. citizen moves to Italy, and Italy and the United States have a totalization agreement. So American moves to Italy, they're going to be subject to Italy's Italy's income tax, and so then they'll, just like with Israel, do the foreign tax credits, take the treaty, do what they can for income taxes. They're also going to be subject to Italy's Social Security program, whatever it is that they're paying into, Italy's program. And the U.S. and Italy have an agreement saying, you know what? If the Americans are living in Italy, they're paying into your Social Security plan. They don't have to pay into the U.S. Social Security anymore because they're paying into yours. Israel and America do not have a totalization agreement. So that and it, by the way, not that it matters, but what I've been told, because everyone yells at me, like, why don't we have one?
Come on, work on it.
Right. And I've been told it's actually more on Israel than on America. I guess the idea is Israel has Bituach Leumi is their social security program. And there's many Israelis that move to America, sometimes long-term, sometimes short-term, Israel has certain requirements of Bituach Leumi reporting for the Israelis that relocate to the U.S. And they don't want to change their specifics. And because of the way Israel treats Israelis that relocate to America and still making them report whatever they have to report to Bituach Leumi, it's not forever, but whatever they have to do, that's a violation of what the U.S. is requiring to have a totalization agreement. So the U.S. is like, well, if the Israelis that relocate to America still have to do whatever that you're making them do to Bituach Leumi, then we are going to make the Americans that relocate to Israel still be subject potentially to the U.S. Social Security program. What that means is that if somebody is, in particular, if someone's self-employed in Israel, U.S. citizen self-employed in Israel, they are likely still subject to even though they're subject to Israelis Mas Haknasa, which is income tax, and Israelis Bituach Leumi, their Social Security, they're still going to be subject to the 15% U.S. Social Security because they cannot claim a totalization agreement to get out of it. However, if you are an employee for a foreign company, so most people in Israel are not self-employed, they're actually working for an Israeli company, the foreign employer, through the nature of their being a foreign employer, is exempt from U.S. Social Security taxes on the employer, not the employee, if there's an employer structure. And so that's how many people avoid having to pay the U.S. Social Security tax even while working in Israel. But the people that are self-employed, or if you're working for a U.S. company, most cases are subject with this extra tax.
So you're a freelancer, you're paying essentially double tax, not double income tax, but double Social Security tax, which can be very, very high rates, right? And if you're working for a Israeli company, U.S. self-employment tax, U.S. Social Security tax is out of the equation, correct?
Correct.
So,
Correct.
Yeah.
It is so worth keeping in mind. Again, it doesn't help you pay your bills today. Yes, it's a double tax. A lot of this extra 15% tax is going to Social Security benefits. People, I'm not getting politically whether that's valuable, how valuable, people have their own opinions. But it is a little different because the concept is you're in theory putting money you're putting money into an additional pension, which is what Social Security probably should be seen as, a pension, not just regular tax. Most of it's going to future Social Security benefits. However, yeah, that you could be talking about a very burdensome amount of tax. It could be very high numbers depending on what your income is.
So drilling down on that, what are some scenarios you might have seen where somebody actually might want to pay this double tax? Obviously, they don't necessarily want to pay Bituach Leumi, and they don't really have a choice, but they might want to be paying this U.S. Social Security tax because of potential benefits that they could go ahead and get.
Sure. Well, for starters, if you're making Aliyah and you have already paid into Social Security for a chunk of time, you want to make sure you qualify for the minimum. You have to qualify for Social Security benefits. You have to earn 40 quarters. That's 10 years, 4 quarters a year. You can do it in pieces. So if you've made Aliyah and you've worked for 7 or 8 years and you've earned 30 plus quarters, so yeah, you probably want to pay in for another couple of years to at least qualify for the minimum. And again, it might get the benefits might not be quite as good. It might not be as much, but it's still paying for 2-3 years. You're going to get a benefit that's going to make it worthwhile. Also, the question is kind of, and this is probably its own
podcast
session on its own, is ways to plan. There are ways to structure your income to avoid the Social Security tax, but those ways are expensive. So you just have to decide if you're earning $20,000 a year self-employment income, which is $3,000 a year of the Social Security tax. Yeah, you'd rather not pay that $3,000. You'd rather have it in your pocket, but if it's going to cost you $2,500 in professional fees, you're probably better off just paying $3,000 to go to future Social Security benefits.
So just to understand, like, kind of the specific there, what are some examples of ways people that are completely freelance are they're definitely going to be self-employed in some way, how they can potentially, structure themselves, to avoid that self-employment tax?
Sure. So the most common way to do it is to find a way to get paid a salary from an Israeli company. A lot of mechanisms for that. The most common is to just make your own Israeli company called Chevrat Ba'am to establish it and pay yourself a salary through it. It's expensive. You're talking like probably
Obviously.
$6,000 a year just by itself. But that's if you've got significant income. There's other benefits to having the company. So step number one is you make your own company and pay yourself a salary through your own company. Uh, I've seen sometimes when people actually like buddy up where they'll find somebody in a similar situation and say, hey, let's start our own company together. That's got its own challenges. I'm not recommending it, but just something I've seen people do. There's also EROs,
Employer
employer
records, yeah.
records, where you'll have different companies that will let you kind of run payroll through them. So they'll take a percentage, be lower than 15% what they take, and they'll issue you a salary, kind of running the books through them. That's also got some benefits of doing it. Those are the most common ways to do it, is to get a salary. There is one other approach, which, and again, I'm not an Israeli accountant, but I'm familiar with Israeli tax. But there is an option if you're getting paid through, if you have a US LLC and you're getting paid through your US LLC, there is an option. It's a little bit of a gray area. You really have to talk to the Israeli accountant to
Understand.
figure out the exact mechanisms. But there is a way where you can have your LLC income, which is essentially your U.S. self-employment income, be exempt from Israeli bituach lomi. So even though you'll still be paying Israeli income tax, but you'll be getting a U.S. income tax. The U.S. and Israel have the agreements on the income tax. You'll pay the Israel income tax, no U.S. income tax. Then you'll be subject to the U.S. Social Security income tax because it's self-employment income. But on the Israel side, you're getting out of the bituach lomi tax, which is also about 15% usually. So there are some savings there. It's a plan that people use sometimes, but has to be considered. There are some drawbacks as well.
Great. Yeah, no, it's good you're touching on this. A lot of complications, but it's also important that you're stressing that people really need to think about this if they're taking money away from a potentially significant retirement benefit and putting it towards fees, putting it towards accounting costs, whatever it might be. You have to weigh those pros and cons carefully and make sure that you're getting more value and more take-home pay and actually getting a better deal out of whatever structure it is you go for. If we jump ahead now and we talk a little bit about something you mentioned previously, which is the savings clause. What does that mean? And tell me a bit about your experience taking the IRS to court, because I'm sure everybody would love to hear about that.
Sure. So the savings clause, which I'm not sure if I haven't mentioned yet, but the savings clause is a really frustrating piece of the U.S. Israel Tax Treaty, where essentially there are many clauses where the U.S. Israel Tax Treaty says different types of income can be exempt. So pension income, right? Not the annuity, just standard pension income. According to the U.S. Israel Tax Treaty, pension income, if you're living in the U.S., if you're living in Israel as a U.S. citizen, all pension income can be exempt from U.S. taxation. Same with capital gain income, and all sorts of incomes are mentioned there in the treaty, which sounds great. However, there is a savings clause, which is something that all treaties have, which essentially says that all of these incomes that the treaty says can be exempt, the IRS reserves the right to tax them anyways. They can invoke the right to tax this income anyways, unless you're these types of income where the savings clause does not apply. So Social Security benefits or the annuities we talked about, those are protected from the savings clause because the savings clause says we cannot invoke the savings clause on Social Security income or on annuity income. So those are protected. However, a regular pension is the IRS has the right to invoke the savings clause to tax the pension income, so that you can't rely on these treaty positions. That's the savings clause. So about 12 years ago, maybe even more, about 10 plus years ago for sure. Tommy and Aliyah about 14 years ago. And I was kind of started off on my own doing some taxes on the side. Eventually, I began partnered with David Waxman and established Cole Waxman, the firm. But I was trying to, was reviewing some things, and I was read the treaty cover to cover. It's actually not as bad of a read as you would expect. The problem is you read the treaty and don't understand it 100%. But I came upon this question. I'm not the first person that had this question of, well, according to the treaty, you can say that a U.S. citizen living in Israel can exempt their capital gains from their stock portfolio. You can exempt your capital gains from being taxed to the U.S. based off of the savings clause. So I thought to myself, this is fantastic. From my bar mitzvah years, had some stock that was, had appreciated, I don't know, $15,000, $20,000. And I'm like, this is great. I've had the stock in my name forever. I've made Aliyah. I've been living in Israel for a couple of years. I'm going to sell stock, have a $20,000 capital gain. Israel is going to let me exempt it because I've got the 10-year tax exemption. On the U.S. side, usually I'd be subject to 10 to 20% tax to the U.S. However, I'm going to tell the U.S. I've got this treaty. I'm taking this treaty position. I'm disclosing I've got this treaty position to exempt this income from being taxed. The question is, what about the savings clause? Because the savings clause comes in and says, well, they can tax me. And I'm aware that they could tax me. But the big question that I was trying to get to, and again, other people had this question too, and still have this question, is, does the existence of the savings clause preclude me from taking the position in the first place? Or can I take the position, and then if the IRS invokes the savings clause, then they can tax me? But it's up to them because, for example, I'm not allowed to say, hey, you know what? I freelanced. I did some work. Blue White Finance, they're paying me. We haven't discussed the terms, but I assume they'll pay me $10,000 for this, for this interview, and we're done.
Yeah, sure.
And so they're gonna pay me $10,000. Great. And I'm gonna say, you know what? I'm not gonna tell the IRS about this $10,000. If they choose to ask me about it, I'll pay them tax. If not, I'm not. That's tax fraud, not allowed. I think we're all aware that that's not allowed to be done.
Right.
So the question is taking a treaty position when the IRS has the rights to invoke a savings clause, is that tax fraud to the point of like hiding money? Because we know the IRS will invoke the savings clause, so that I can't take a treaty position because they will invoke the savings clause. Or can I take the treaty position and just say to the IRS, do you want to take it or not? It's up to you. And then if you want to take it, okay, then I'll pay you the tax. And it's a really big question. So I took it to tax court. I filed it. Like I said, I took the position, and the way tax court worked, these things are really slow. So I took it at first thinking it was like a clever little thing, which I was happy about. And then over the next couple of years, I got really interested about it. I talked to a lot of professionals that were, they said, listen, you can't really do that. You're not, the consensus is it's not allowed. But I was hoping for a little more clarity. So I actually, I got myself audited. I would have gotten away with it if I didn't try to publicize it, but I wanted to take this to tax court. So I had some self-employment income. I did a few things. I amended my tax return a few times till I got a flag to get audited. And so then when I got to audit, I said, just pass me on to tax court. I want to go to court. For the states, I spoke to them a bit. In the end, we didn't even get such a clear answer, depending who you ask, because the IRS went ahead and they invoked the savings clause and they taxed me on these capital gains, and I paid the tax that was expected. However, when it comes to the penalties and the interest that they charged, they did not actually charge me penalties or interest from, let's say, I think I did this, let's say it was a 2010 tax return, and we're settling in 2014. Okay. Usually there'd be 4 years worth of penalties and interest. They ended up saying, well, we're not going to charge you the penalties. We're charging you as if the tax was created in 2014, which implies in 2010, when I took the position, it was legitimate to not tax myself.
But then they invoked the savings clause in 20. 2014. And
Correct, which implies that it's a legitimate position to take, and then it's the IRS can invoke the savings clause, and then you pay the tax when they do it. It sounds good. It doesn't actually fly.
Don't try this at home.
Don't try it at home. I wouldn't do it for somebody. I wouldn't do it for myself. I wouldn't do it for somebody else. The top tax attorneys that I've spoken with have said that the fact that the IRS says that they may invoke the savings clause, it means they will. The may means will. And if it's a definite that it will be invoked, then it's essentially the tax law. You can't take a position that you know goes against what the IRS is going to do. So the savings clause at this point, it's been challenged by other people as well, from other countries as well. And at this point, the IRS has been pretty steadfast that savings clause should be treated as an absolute. And if it gets challenged, it's going to be invoked. So it should be assumed as invoked on its own.
Do you think we'll ever see the end of worldwide taxation of U.S. citizens, or unlikely?
I wouldn't think so. It would be unlikely. I mean, as you know, it's essentially the only real country that has a worldwide taxation. Yeah. No offense to anyone from Eritrea listening, which is also a real country, but the U.S. it's a pretty significant piece of tax that they have. I could see it being, some of the rules are just so old that it seems like those should be updated. So, we talk about the treaty. There's nothing really in there to protect you, and not much there. A lot of people have people living in Israel have Israeli pensions. They've lived in Israel their whole lives, and they've got Israeli pensions, Keren Ishtomot, Pensia, Kupot Gemel, different types of Kupot Gemel. Will there be a treaty to protect someone that's been living in the country their whole life from having to pay tax on that foreign income? Maybe. Should some things be adjusted? We talk about, there's this FBAR requirement, which is if you have over $10,000 in all of your foreign financial accounts, you have to report it. That's from, again, the FBAR started late 60s, I think. At $10,000. $10,000 in the 60s is a lot different than $10,000 in 2024. So even something simple like adjusting that number from $10,000 to $100,000 wouldn't be a huge change, but it seems to me that somewhere down the road, there should be some changes that would probably make life easier for people in simple situations, but probably harder for people in more difficult situations. Because I would say for the FBAR, if it was me, I'd say, okay, if your total of all your accounts are under $1 million, don't report anything, don't file anything. But if it's over $1 million, do a much harder report. Maybe disclose your real estate, disclose this. I get forcing hard disclosure on people that have higher income, but the 22-year-old that just has, $15,000 in their bank, maybe a few $1,000s in a pension, to have to report that every year. That seems like it's not in line with what the intent was 50 plus years ago when these things were set up.
Aliyah, this has been fascinating, just unpacking this. And I know this is a complicated subject, and I know Elyma are trying to understand this a bit more. So this was a great deep dive. I'm going to put some links under the video where people can reach out, but tell us a bit more how people connect, follow your work, and get in touch with you and your firm. Sure.
Best way is email, just because I'm awful at answering my phone unless I have a scheduled meeting. Awesome. So best is just shoot me an email. If it's something that, someone really spoke about, as I mentioned, is more Israeli accountant or potentially even an attorney. So I can certainly point you in the right direction if it's not me. If it is me or my firm, happy to help you. We can do consultations pre-Aliyah. We do tax reporting post-Aliyah. And happy to help any of your listeners however they need. Amazing. Thank you so much for coming on and sharing all your wisdom. And thanks everybody else for listening. Be sure to check out a lot more at bluewhitefinance.com. And we'll see you next time.